When mortgage rates go high, there are strategies that you can use to get yourself a lower mortgage rate and bring yourself closer to buying the home of your dreams. Let's get into it. I'm Dan Green with homebuyer.com. My NMLS is 227607. Our lender MLS is 423065. We're part of Novus Home Mortgage, a division of Exonia Bank. You can read more about homebuyer.com in the video's description, including our lending coverage and some very important disclaimers. Also, don't forget to hit the subscribe button because this channel is full of excellent mortgage video, and I'm a mortgage guy. Talk to a separate licensed expert for your legal, tax, and financial advice. But when you are ready to start your mortgage pre-approval, you can, and we hope that you will, do it on our website, which is available to you anytime subject to approval, 24/7 at homebuyer.com/fast. Okay, this video is a strategy video with 10 distinct mortgage strategies, some that work together, some that stand alone to get a lower mortgage rate. These strategies should work anywhere. You don't have to work with us to use these plans so long as you meet your lender's requirements and qualifications. So that brings us to the first strategy for getting a lower mortgage rate. Strategy 1, close on your home faster. This first strategy for getting a lower mortgage rate is about mortgage rate locks. That's your mortgage lender's commitment to give you, the buyer, to honor a specific mortgage rate for a specific mortgage product for a specific number of days from the date of your rate lock through the loan rate lock expiration. If you choose 15 days, you get a 15-day commitment. If you choose 30 days, you get a 30-day commitment, and so on. Mortgage rate locks are generally grouped into 15-day windows, and each 15 days additional generally raises your rate by about 1/8 percentage point, 0.125 percentage points. Not always, but usually. So if you buy a home and close in 15 or 30 days, that will generally get you a lower rate on your mortgage than if you close in 45 days or 60 days. So when you write your contract, think in 15-day increments. Don't close in 46 days, close in 45. Don't close in 31 days, make it 30. Strategy 2, pay for mortgage discount points. Now, mortgage discount points are upfront fees paid at closing that get you, the buyer, access to lower interest rates. The discount in discount points is the interest rate discount, the reduction in rate. And assuming that you're eligible and your lender allows it, you can get as many or as few discount points as you want at your closing to bring your interest rate down. In general, but not every time because lenders and loan programs vary, but in general, every point you pay can lower the rate on your mortgage by about 1/4 percentage point, 0.25. And the cost of a discount point is 1% of your loan size, the amount you're borrowing. So if your mortgage size is $100,000 and you're paying 1 discount point on your loan, that point costs you $1,000. Now, you may not like this particular strategy to get a lower rate because it adds to closing costs, and you may prefer to save your cash for other things such as furnishing your home. That's okay, totally fine, because there's another way to put discount points on your mortgage that doesn't cost you cash, and that's to have the seller pay mortgage discount points for you, which brings us to strategy number 3, seller concessions. Seller concessions are when the seller takes money from the closing that it's collected and gives that money back, concedes it to you, literally, the buyer, for costs associated with the purchase. And they can be for anything home purchase related. It can be for government fees, the cost of an appraisal, for title fees, and discount points. You can negotiate with the seller to take some of their proceeds and lower your interest rate with it. This is different from lowering the sales price to make the home more affordable. This is lowering the interest rate to make the home more affordable. That brings down your monthly payments. Now, if this feels weird to you, it isn't. Seller concessions are so common that they're included in the official mortgage guidelines for all the major loans, for conventional, FHA, VA, USDA, jumbo, which also means that there's a rule book for how to write them into a contract. However, concessions are subject to caps and restrictions based on loan type and lender. So if you plan to use seller concessions when you buy your home, talk to your mortgage lender and ask what you can do. Strategy 4, do a temporary mortgage rate buydown. Temporary mortgage rate buydowns are a form of seller concessions like we talked about in strategy 3. They're just a little more focused on just your interest rate. Temporary mortgage rate buydowns lower your interest rate temporarily for a year, for 2 years, or 3, depending on how you want to set it up. The length of your buydown, the number of years, Well, that's how the program is named. A 3-2-1 buydown, it's for 3 years of rate reduction. The 2-1 buydown is for 2 years, and so on. So on a 3-2-1 buydown in that first year, your interest rate is 3 percentage points lower than your permanent rate. Then in the second year, your interest rate is reduced by 2 points from your permanent, and your payments are based on that rate, 2 percentage points below. And then in the third year, your rate is reduced by 1 point from the permanent rate. And you make your payments each month off of the temporary rate so that after 3 years are done, your original rate returns. The cost of doing a mortgage rate buydown, of taking that temporary reduction in rate, it's roughly the same as the accrued difference in mortgage payments that you would have made in dollar terms over the same 3 years. So if you do a 3-2-1 buydown and it saves you $8,000 in mortgage interest, the cost of your buydown will be roughly $8,000. So why would you do a temporary mortgage rate buydown if the cost and the savings roughly equal out? And the answer to that is you wouldn't, but your seller might pay for it as a seller concession because paying for your buydown may cost less than paying for mortgage discount points. Strategy 5, use an adjustable rate mortgage. Adjustable rate mortgages, ARMs, ARMs, they are mortgages where the interest rate can adjust over time. Adjustable rates are an optional feature on a mortgage that lets you, the buyer, share in time risk with the lender. ARMs come with an introductory period that can last for a few months to a few years, and during that period, the mortgage's interest rate is often lower than a comparable fixed rate loan, which doesn't change over time. So ARMs can be an effective way to secure a lower initial mortgage rate on your loan, but they do come with the potential for payment increases over time. Always discuss the specific terms and potential risks of an ARM with your lender before choosing one. Strategy 6, raise your credit score. Another tip for getting a lower mortgage rate is to earn a higher FICO, a higher credit score. Now, this strategy doesn't apply to all loan types. It may not apply at every mortgage lender equally, but for many conventional mortgages, with every 20-point jump, your lender may give you better mortgage terms, including a lower interest rate. Because with conventional mortgage loans, loans that are backed by Fannie Mae and Freddie Mac, credit score is an input for the math that makes your rate. So how do you add 20 points to your FICO? Your results may vary. A few common ways, according to myfico.com, would be to bring your bills current as best you can, to reduce your outstanding balances on your credit cards and charge accounts, to dispute and remove erroneous credit score reporting, to raise your available credit limits. There's a lot you can do. And regardless of today's mortgage rates, these are probably steps you should take anyway. Raising your credit score pays off on more than just your mortgage. Strategy 7, use HomeReady or Home Possible if they're available to you. HomeReady and Home Possible are mortgage programs. They're similar, and they're backed by Fannie Mae and Freddie Mac, respectively. HomeReady and Home Possible, if you're eligible, they offer lower mortgage rates compared to other conventional loans because they waive certain risk-based pricing. Rates can be a lot lower, actually. And HomeReady and Home Possible offer lower private mortgage insurance rates compared to other similar loans. Both programs, they have income limits for buyers, and lenders may put their own restrictions on top of that. So ask your lender whether or not you're eligible for HomeReady and Home Possible. They are two home affordability products that could be a fit. Strategy 8, use a first-time home buyer mortgage program. Another way to find relief from rising mortgage rates when mortgage rates are high is to look at municipal, state, and national first-time home buyer programs that may offer low interest rate loans or that may give cash grants or other breaks that can be used to buy down an interest rate in the form of buydowns or discount points. Ask your lender what programs you may be able to use. It can be a little bit of work to find them, but it also can be worth it. Strategy 9, increase your down payment to the next 5%. This is another strategy that's mostly limited to conventional mortgage buyers using mortgages backed by Fannie Mae and Freddie Mac. This strategy specifically doesn't work with the FHA, VA, or USDA, or jumbo, typically conventional loans only, because with conventional loans, mortgage rates are made differently. There's a base rate, a floor, a starting point for your calculations, and then adjustments get made to your rate based on risk. Now, one of them we talked about already, credit scores. 20-point differences in your credit score can change your mortgage risk and rate. Another risk adjustment is based on down payment. Now, this is subject to other criteria and to your lender. If you're doing a conventional mortgage loan and you're putting down 3%, You can get a lower rate generally by putting down 5%. And you can get a lower rate a little bit more by putting down 10%. And again, by 15. And every 5% increment until you get to about 40% down has the effect of lowering your rate, usually. But then the advantages stop. So there's some caveats here. The first is, again, this is Fannie and Freddie's loan level pricing adjustment matrix, which has changed a few times in the past few years. It can always change again. So check with your lender about that. And in the current iteration, this plan does not apply to 15-year loans, only 30 years. And if you have a credit score that's average or below average, the discounts don't kick in until you put in about 20% down, something like that, which is not something that most buyers do. Lastly, the last caveat, and this is worth knowing, if you're using HomeReady and Home Possible, you're already getting a discounted rate, so none of this would apply. So this strategy is a stretch, but it's there, 5% extra to your down payment. Lastly, strategy 10, get multiple mortgage rate quotes. This should probably be first on the list. It's okay that it's last, so you'll remember it. Get 2 or more mortgage rate quotes. 2 is fine, 3 is better, 4 is optimal. Any more than that, shopping for rates becomes a full-time job, and that's not good. But the reason why you comparison shop, which you may not know, it's not to pit mortgage lenders against each other, like when you're buying a car. Lenders don't work like that, offering price cuts because of the next guy. That would violate laws of fair lending. The reason why you comparison shop your mortgage is because sometimes a lender is in the market with their mortgage rates, and sometimes the same lender is out of the market with their mortgage rates. The pricing fluctuates daily. Sometimes a mortgage company wants a lot of 30-year loans on their books, so they make the rates really low to grab up market share for those types of loans. And then later, they may have filled a quota or changed their plans, so they price their mortgage rates up. Now, as a buyer, you don't know where a lender is on that pricing scale at any given day, and you won't know unless you talk to one or more of them. Freddie Mac did a great study on this. They found that home buyers who do talk to 2 or more lenders, they save $1,500 on average just for making a second call. So do that, get another quote. And that is 10 great strategies for lowering your mortgage rate. I do want to use the tail end of this video. I want to talk about strategies that I don't love, some of the bad advice that's disguised as good advice, because YouTubers, TikTok, influencer types, it's very easy for people to talk about mortgages, especially if they don't have a history or background working in mortgage. They're not subject to basic industry compliance like UDAP or fair credit laws. So some of that advice straight up wrong or harmful, like the strategy to get a lower mortgage rate by shortening up your loan term. I saw a video that said to do a 15-year mortgage instead of a 30-year because the interest rates were lower and they save on interest costs long term. That is mathematically true, although 15 mortgage rates aren't always less than 30. But when you do that and you take the shorter loan term, your monthly payment is usually much higher because you're compressing payments and your debt to income may move beyond what's comfortable or even approvable. So that advice may not be for you, may not be appropriate. I saw another video where others had suggested that people float their mortgage rate, float the rate on their mortgage, which is to not lock your rate, to not have a lender's commitment of what your rate will be. Rate lock commitments are contracts. They're between you and your lender. And what they say is that a lender will honor a specific mortgage rate for your mortgage for a specific number of days. When you float, there is no rate lock and there is no commitment. So you're subject to changes in your interest rate before your closing. Maybe rates do come down while you wait for your closing, but relying on market changes may not turn out how you want, and uncertainty is not a strategy. Market rates can rise while your mortgage rate is floating quickly sometimes, and that can affect your approval. So rate locks protect home buyers from interest rate fluctuations, and they don't guarantee a loan approval. So talk with your lender. If you decide that you want to consider floating, you'll be able to get some good opinions there. And that is the video. Strategies for lowering your mortgage rate, 10 ways to do it, plus a few you may want to avoid. I'm Dan with homebuyer.com. Remember, pre-approved buyers do better. Happy home buying.